All right, welcome everybody. Today we are talking all things finance, WTF with the finance. I mentioned earlier, but this is part of one of 4 series on with the stories they didn't tell you about business. So Jess is going to be talking about revenue, profit, financial statements, KPIs, utilization, actual cost, how they talk to each other, why they talk together. We're going to talk about basics, and then we're going to go beyond the basics, just understanding the why, being curious, asking good questions. She's very good at making you think. So in a fun, practical, and understanding way. She's got a way of, even for me, who's been in this field in finance for many years, she has a way of making me look at it differently and making me just aha moments of why we do what we do. And even in all of our roles, we might not understand that our function is a revenue generating function in a direct or an indirect way. And so she's going to help you understand how that is, why that is, how it affects your team, and how it helps your leaders, and beyond that, other stakeholders you might not even think are important, but they are: your lenders, your bankers, government officials, and just a whole array of people. So let's chat about Jess's journey a little bit. I've been working with her for about 2 years, and I think she's brilliant and magnificent, and she's just the best hype squad ever. She's just great with intros, so I'm probably not going to do this justice, but I asked Jess to give me a unique or random thing that people would be surprised to know about her. And she gave me 2, and one of them I didn't know. So she started her career as a secretary, which is fascinating when you think about where she is now. She's also a licensed civil engineer. In between all of that, she's been in admin, in HR, operations, finance, project management. She has done everything that we do, or that we will do, or for people that we're going to oversee. So she really has done it all. Which has led her to 1029 Consulting. And that's a company that she's owner of right now. And she does coaching, peer-to-peer advisory, she's unstoppable. So I'm super, super excited that you guys are gonna get to have an hour of her wisdom. I think that this is a good time, Jess, for you to tell us about your story of 1029 Consulting and how you came up with the name, and then taking it away, because we're super excited.
Well, thank you all for having me here. I'm really delighted. I hope I can, bring the answer and set your expectations so high that I completely exist. But, when you're starting a business, I started my consulting business in 2008, which, of course, many of you might say, what were you thinking? Which I asked myself many times, because I did it right in the middle of the year. And what was I thinking? But it was, it happened, it worked. That was almost 14 years ago. It's been going strong, some years better than others, but that's business, right? And when I was going to name my company, I got a lot of advice from people to say, oh, you got to name it so people know what you do. And it's kind of like, well, how do I name something about operations management consulting when everybody thinks about that differently? And my operations management consulting focus was on the administrative side: IT, marketing, sales, finance, accounting, HR, admin times 2, all that. It wasn't about field operations in construction. It wasn't about any kind of anything outside the administrative side. This is the engine that makes everything run. But I look at business, I'm a sailor. I have a sailboat. And 1029 Consulting has 2 meanings. Number one is, you can see on the bottom right-hand corner, there's a little clock next to the little clock logo. 1029 in the morning is when most busy people look up from their desk and say, holy, how am I going to get everything done today? And I see a lot of nods. And now what's really funny is every once in a while, I'll look up and I'll go, geez, I'm really busy. How am I going to get it all done? Oh my God, it's 1029 in the morning. And I start really early. So the other piece is, as I said, I believe business is a lot like sailing. You got to have a course. You got to have a destination and a course. You need a crew. You need environmental things going on, mostly wind. Sun is always nice. Rain is okay. It's not as much fun. And 1029 happens to be the whole number of our sailboat. So it meant it was a double meaning for me. 1029 is when people are really busy. They look up and they go, how am I gonna get this done? I need another pair of hands. That's me. And also 1029 is for the sailboat, which I look at and say, this is what I think about when I think about business. Businesses are like sailing. And you will find in my email signature and one of my email accounts, I can't remember which, is that we cannot control the wind, but we can change the sails. So it's adjusting, trimming, and moving on like that. But today, Brittany says we're going to talk about all things finance. I'm going to talk about some things finance. And really the goal of this is to pull together all of the very detailed education I understand you had about all of the reporting, thinking about bankers, all those kinds of things, and putting them together, hopefully in a way that helps you think about where you might interact in all of this, as well as why did they do that? Why did they make that decision? So to start off though, I want to get a little pulse of the audience. And so what we're going to do is we're going to talk about revenue, profit, and cash really quickly. Talk about everything that businesses have in common, because let me tell you, I'm going to burst your bubble right now. You are not special. And I'll tell you why. Talk a little bit about developing goals and KPIs, and then the relationship between all the tools that I'm talking about and actually running the business. And then I'm going to leave you with something that hopefully your financial people are going to look at you and say, holy cow, they're really smart. How did they figure that out? So I'm going to leave you with that, hopefully. So question for you, and we're going to do this as a poll. What's most important in business? Revenue, cash, or profit? You got the next 30-ish seconds to answer, and then we'll put the results up. My Vanna White, Brittany, will take care of that.
Yeah, well, actually, now that I'm getting an error saying you're logged in from another device. So I think somebody logged into this account while I'm in it. So it is, I tested it before we went and it's now saying no. So backup plan is I'm going to put 3 options in the chat box and then everybody just respond there.
What I'm going to do is I'm going to ask for instead of the chat, because it's really hard to read, I'm going to ask for you to respond with hands, which means
good thing we have a backup plan, because yeah. Always be prepared for.
Who says revenue is most important in business? The people I can see. I don't see anybody. How about cash? So 1, 2, 3.
I'll read it to you. So we've got a lot of profit. Let's see.
Yeah, a lot of twos.
Yep.
How about profit?
Lots of profit. A couple cash and no revenue.
Okay. Well, this is a smart group. Okay.
Yeah.
Well, let's talk about it. So here's the deal. It's cash. And for those of you that said cash, it's great. And this is why. Think about this. Here's a balance sheet. Now, this isn't exactly, you can have a statement of cash flows, but balance sheet's a little bit easier to talk through. You have their assets. You have cash in the bank of $5,000. You have AR of 40, and you have fixed assets of 50,000. And on your liabilities, you've got accounts payable of 50, because that's the advance charge for your fixed assets. You've got a note to the bank for $20,000, little shareholder capital of 5,000, and you've got your year-to-date earnings, which is known as profit, of $20,000. But you have $5,000 in the bank, and you owe a supplier $10,000 right now. Okay, where are you going to get the cash? You don't have it. Now you have profit, that's great. And you have potential revenue, which is your AR. So revenue is important, absolutely, because off of it, you make profit and you have cash. If you don't have cash, you're done. Can't pay payroll, you can't do all those other things. So want to keep that in mind. One of the ways that you can do this is this is really interesting, because when I was the director of operations for another professional services firm, we were looking at bonuses, and I said, you don't have enough cash to pay those bonuses. And they said, oh, we'll use our line of credit. And I'm like, oh, no, you won't. You got $1 million in AR, go get it. You've got 3 months. So and a major portion of that belonged to one guy. And how about that? He got it all. So we covered bonuses with the cash because we let AR go for too far. Megan, did you have a question, or you're having a different conversation? Okay, she's having a different conversation. All right, we'll move on from there. Any questions about that? Any questions about, this is a really simple balance sheet. Yeah, I don't have SG&A showing here, so, but, so let me talk a little bit about, what's not special about business. And this comes from a conversation that I had with a guy in tech. And he was saying, well, we're special. We're in technology. We change over, everything changes for us every 6 months. Now, the timing of this was really interesting because it was April, May of 2020. So the pandemic had just hit and the tax laws had changed on the 1st of January, 2020. And then the IRS said, oh yeah, we're going to move the April 15th deadline for taxes way out to August or October or whenever they moved it. And I challenged him to say, I think CPAs probably had to learn the most ever in the last 3 months than anybody in tech has in the last 6 years. And he said, okay, I'll give you that. But what am I going to learn from a plumber? Stuff runs downhill. I don't know, but it was an interesting thing. And what I found after a lot of conversations, every business does the same 4 things, no matter what you do. If you're selling services or you are delivering barrels of honey, they do the same 4 things. They sell, they deliver, they collect, and they govern. So think about it. And this is very broad. This is general. Okay. So selling is about revenue. Delivering is once I deliver it and collect the revenue, there's a profit involved. I collect cash. And governing is the strategy that drives all of this and drives the requirement for all of the financial tools that you might want to use. So it's setting billing rates, utilization goals. What's our staffing approach? What clients do we want? What's the vision of the company? What's our marketing strategy? All those things roll into how you sell, deliver, collect. So if every business does the same thing. If you think about it, you can, okay, so I'm a plumber. Well, you sell the job, you deliver the job, you collect the money, and you govern the company. Pretty easy. Again, very high level in general, but that's what every business does. So let's think a little bit about, these are all the tools that I understand you've been through or talked about and concepts. So tell me a little bit, somebody tell me what the profit and loss statement tells you. Not you, Brittany, your finance.
And Jess, like we talked about, there's a couple of people who are new to the group, or so there might be, some people who haven't had some of this. So
that's okay. Well, I'm going to give you an answer, but I want to hear what someone else thinks. So you can just turn off your mute and you can unmute yourself and chat away. Anybody want to volunteer? All right. Well, revenue, profit and loss is going to tell you revenue, costs, and expenses from a certain time period looking backwards. It's also known as an income statement. These are a specific time period, and it's a snapshot. Balance sheet, you've seen one. Assets, liabilities, and owner's equity, again, at a certain point in time. And a lot of this is, people get confused because they're saying, well, this isn't telling me how much money I have in the bank. Well, of course not. It's a snapshot in time, and it's not talking about cash. Statement of cash flows tells you what's going in and out over a specific time period, usually a month. But again, still, it's a specific time period. So you actually have to go to the bank and figure out what you got in the bank. Okay. Utilization. This is a big deal for professional services firms. Utilization is high on the list of how you sell, deliver, and collect. And it's a percent of total staff time charged to billable projects. So also known as a percentage related to direct labor. And then multipliers. It's the effect of burdening direct labor with indirect costs. Do you all know the difference between direct and indirect? Okay. For those that might not have been through this, direct cost is the direct salary of someone. And their indirect costs are rent, utilities, benefits, taxes, all of those other things that are not part of actually delivering the work. Key performance indicators. I find this really interesting. A lot of people say, oh, let's look at our top 3 key performance indicators out of the 15 that we have. And my response is always, that's way too many. You want 5. Pick the 5 most important and look at the top 3, or just pick 3. Then you don't have to look at the top 3. You've got 3 that apply. They're a measure of how on track you are to reaching a goal. I have a client who can't keep goals and KPIs straight and keep saying, I've got a KPI of $55 million in revenue. It's like, no, that's a goal and you're off. Your KPI says you're off. You're not going to make it. So she keeps looking at me like, what? You need to be looking at how are you progressing towards that. Employee costs, the total amount paid for an employee that includes salary, wage, taxes, workers' comp benefits, but not their bonus. Okay. And then overhead, the indirect expenses as a percentage of direct labor. Now, multipliers are going to come into play in a minute when we talk about how people make decisions based on all of this information, or might make decisions. Not everybody does. Sometimes it's just a gut feel and they just go. Questions so far? Is there something in the chat that we need to know? Casual.
No, we're just talking about the king.
Yeah. Captive queen.
I love it. Yes, ma'am.
All right, let's talk a little bit just briefly about goals and KPIs. I've seen a lot of nods when people are saying, yeah, goals, KPIs. They're not the same, as I mentioned. So if you have a $120 million annual revenue goal, the KPI might be $10 million a month. Are we doing 10 million a month? It's pretty easy. I did this because I can't do complicated math in my head on the fly, even though I am an engineer. Goal might be 80% average utilization, and you might look at 80% total utilization per month. That's a little, that might be the KPI. I didn't like looking at utilization monthly because quarterly was a better picture. But that all KPIs, they need to be appropriate. They could be weekly, monthly, quarterly, semi-annually, annually. It all depends on what's appropriate around the KPI. Then the goal, 12% net profit. Most people will look at net profit over a quarter instead of monthly. It's going to be too much of this going on, especially in professional services where projects start all the time. And so at the very beginning, projects aren't profitable at all. And then they grow profitably over time, hopefully, if you budgeted them right. So quarterly net profit is probably about as often as you want to look at, but you want to keep a finger on it because you make decisions based on KPIs. So should we, if you, for instance, if you have a $10 million a month KPI to get to your 120 million, you do 10 million in January, 10 million in February, 8 million in March. What just happened? And then you go to 12 million in April and you go, oh, great, we're back on track. And then you do 13 million in May. What happened there? Oh, that was a project we didn't anticipate. Okay, are we going to continue? So it allows you also to do a forecast to look forward and say, given that we added this project here, what is our now revised forecast? Look, are we going to hit our goal? Or are we going to, are we going to have to write something off later in the year? Is there a bad project sitting there? So it's a lot of really good information around how to make decisions quarter by quarter, half year by half year, month by month, however you look at it. Any questions there? Thoughts, comments, objections, arguments? No?
Jess, I just wanted to mention that you actually taught me something I thought was super helpful with it when utilization per role. So, it was something we kind of just did an average firm wide and we knew our break even utilization, but just, so, every role is different. Like some, if you have a principal, maybe they're only 20% billable and 50% marketing. And, so she really had a really great way of looking at it. So I just thought I'd throw that out there.
Thanks for the reminder. We actually, at the firm I worked, I was the director of operations for, we looked at that and we did look at every single role and say when we wrote a job description, we said, what is your range of utilization? So anybody that came in, we had a conversation with them about, okay, so you are a senior project architect, your range of utilization sits down between 75 and 80% a month because you have to do some selling. That's an expectation here. You're going to have some admin time. An architect, a project architect, and they are licensed, so I'm not breaking any titular laws here. So project architect or just a designer's expectation was 90 to 95% utilized. And we had a lot of arguments about the 95% utilization because some people felt that doing time cards was chargeable and some people didn't. So, it's up to how your firm looks at it. It's perfectly plausible, but not every firm likes to look at that. And the other piece is that some people do, kind of blended utilization, which is much more complicated and something that hurt my head. So I didn't want to do that. But there are arguments about, so we had a lot of arguments about, well, people need to work 45 to 50 hours a week. We're like, we only pay them for 40, and you can ask them to do that, but it's not particularly okay. So, and what we did do though, is every month, I think it was every 2 weeks or every month, I can't remember, we would put out a utilization report. So everybody got to see their and everyone else's utilization. And boy, howdy, did people start paying attention to that. Now they screamed for the first couple of months saying, you're going to penalize me. It's like, no, we're trying to help you understand. You are the revenue engine of this company. And when your utilization drops, the engine starts to stall out. If we drop below 63%, which is our break even, then we have a problem. And people are either not putting their time in right, or they're not working. So we wanted them to understand the impact of their vacations on utilization and what other people have to do to pick up and all that information. So it's a really interesting decision-making tool. But that was revolutionary at the time. We did that way back in 2004, I think. So best practices for KPIs though, again, not 15. They need to balance leading and lagging. Do you all understand leading and lagging KPIs? So a lagging KPI is how many sales were closed. I like to say, if you only have lagging KPIs, it's like walking around a 2-story dark house with a flashlight pointing that way. You're going to fall down the stairs. Okay. It's just going to happen. If you have leading and lagging, it means you got flashlights pointing in both directions. So a leading KPI might be, we want to increase the number of leads in our sales funnel by 10% every month. That's great. So your pipeline will grow. Look, we're getting lots and lots of leads, but are you closing them? So it won't always be a great indicator of how you're doing unless the other half of that happens. So like I said, lagging records actual performance, leading gives desired performance. Reported frequently, weekly, daily, or weekly, monthly, quarterly, whatever fits both the KPI and your reporting kind of your reporting cadences. And then it needs to be public at appropriate levels. You're not going to give everybody on staff all the financial information. And where financial information lands varies by firm and by the ability of the leaders of those firms to trust that people aren't going to do something weird with it. Okay. So, reporting is appropriate to create the alignment on the KPIs to understanding and transparency at the right level. And then it needs to be a push, not a pull. So we talk about scorecards and dashboards. I'll be honest, my experience, and we had this conversation on another team the other day, is some of these people that lead firms or lead work, and it may not be so much in the firms that you work for, don't know how to turn on the lights, let alone pull a report on a KPI. So it needs to be visible and available, and it's a push. You get it, accounting or finance pushes those out every month, every quarter, every week, whatever those are, they need to come out. And hopefully all of you have access to a lot of this kind of information, a lot of the KPIs that are going on. But my counsel always to firms is have three that you look at. And the big one for leaders is the KPI that is known as asset turnover. And this is, assets are also people. So it's really revenue divided by the average asset. So the way you do that is, and you can look at this, is you look at your revenue and you look at your fixed assets in January and your fixed assets at the end of December, and then you divide that into revenue, and that's an asset turnover. So in an asset turnover, this works more in manufacturing where you have inventory, because inventory is big on impacting your asset turnover percentage. That's one of the big KPIs or that leaders should take a look at. They should only have a couple, but it's a telling KPI. All right. So if you look at the tools and you look at the way what businesses do, they sell, deliver, collect, and govern. So profit and loss talks about delivery and collection and governance. Profit and loss, what's our income? What decisions have we made to get revenue? Balance sheet's going to look at governance. What are we doing with all of this asset and liability? How are we managing those? Cash flow statement about collections, again, about governance. What kind of rates are we pulling? What's our utilization rate? What do our clients look like? Multipliers talk about how you deliver, how you collect, and how you govern. What's the multiplier going to be for this client? We have a public client. They only let us do a 2.1 multiplier. Well, 3.1 is desired. Okay, so or 2.5. That was a conversation continually at our firm about, we have the DoD and we have the state of California and we have Lake Washington School District, and then we have Microsoft. Okay, so those were some of our clients, and Microsoft was great. So 2.9 multiplier, woohoo! But the DoD was 2.3. So we had to balance. We had to make decisions based on all of that. Employee cost, that's about selling. How much can we charge for our employees? We know what they cost. Can we cover their cost? And then some with a multiplier. And then how we govern. What employees do we put on what projects? What projects do we take? Overhead, same thing. And this is in general. Goals and KPIs, actually, everything applies to all of it, but these are the ones that are most applicable. Goals and KPIs, selling, delivering, governing. Not so much on collections unless you're having trouble collecting. Anybody have a sense of what a really good profit margin is for an AE firm when you're killing it? For those that work in it? Used to be 18%. I don't know quite, that was quite a while ago, but 18% net profit was killing it. Compared to, think about it, in the construction industry, the best in class HVAC contractor has a net profit of 5%. Best in class. Okay, it's a real difference. It has to do with risk. When you get paid, because your AR is going to be in there, so it's a pay when paid, right? You're always lagging 30, 60 days behind, maybe 90. And so, and then contractors, 2 to 3%, best in class. It's crazy. So 18% for an AE firm is really killing it. So, that does a lot for trying to figure out how you're going to govern. All right, so let's talk a little bit about making business decisions. And please feel free to jump in anytime if you got questions. So one of the first business decisions, and I love this, there was a mechanical engineering firm that I worked with that said this. Let's talk about customer retention. We're looking at 4 customers. And customer A is low volume, high multiplier. Customer B, low volume, low multiplier. Customer C, high volume, high multiplier. And customer D, high volume, low multiplier. What's the first customer you might think about getting rid of? You have to unmute yourself, Carrie.
I was going to say B.
Okay. Okay. All right. Why?
You end up doing a lot of work for a little bit of money.
Okay. So you can see how the multiplier starts to help you make decisions about what clients you're keeping, your client selection, what your client mix is. We got to a pretty good balance with the DoD and Microsoft and state of California and city of New York and all the public work that we did, along with so we did work for Microsoft, for Starbucks, for other privately held companies. They might have been public, but they weren't public agencies. So this is a great conversation in the marketing side. Well, hey, we're doing all of this. We have all of this work, all these great people on this really crappy work that we're barely covering them for. And the work may not be very interesting either. If it's a lot of fun, now you have to, fun and creative and, it works well on the resume for the company, then you kind of need to think about how you're going to do that. But from a financial point of view, without that filter on it, you can use multipliers as a tool to think about what customers do we want to keep? What customers do we want to get? Should we get rid of customer B so we can get customer E, which is maybe high volume medium multiplier, but a whole lot more interesting? I don't know. Questions, comments, thoughts? Okay. So a new business line.
There is a question about multiplying what by what.
Okay, good point. So let's talk about multipliers. So multipliers are on the employee wage. So you have an employee that gets paid $100,000 a year in salary. Their hourly rate is $48 an hour. Okay, so we're all talking hourly rates here. So a 2x, 1x, I cover the salary, 2x, I cover the overhead. So the 2x is $96 an hour. All right, I could charge 2x, a 2.0 multiplier, but I'd simply be breaking even on the employee. So a 3x multiplier, 3.0 multiplier would be $144 an hour. Will the client pay that? Can they afford that? So there's a 3.0 multiplier. A 2.8 multiplier would be $134 an hour. All right, and I just chose $100,000 out of the air, so everybody makes a different salary. So it's and their hourly rate's different. So you can tinker with the multiplier on that hourly rate to say, how do I you can do a blended rate. Some firms do a blended rate. It's $95 an hour for whoever you get, or that was a long time ago, so it's probably more like 130 or 150 an hour for everybody. You know, whether I pay them at the $150, you know, a third of whether I pay them $50 an hour or $35 an hour based on their salary. Does that make sense? Does that answer your question? Yeah. Okay. So let's talk about a new business line. In my world, when I said, hey, I wanted to start this business line doing X, Y, and Z, my boss, the managing principal, said, well, can you bring in $1 million? You get $1 million in revenue in that market niche. So that was 4 people working a year. Can you keep 4 people a year employed? $250,000 a year. So you're thinking about what's the potential revenue you need to have a new business line? What's the potential utilization rate? Do you need more people? Can you squeeze this in with who you've got? What's the potential multiplier that this market will bear? So it's market on the business line. And is there availability in that market niche? So we started doing some work for Starbucks that I was trying to work on expanding into other clients. It was due diligence for retail locations. So we talked about it and said, yeah, no, there's not a whole lot of people that are doing this except for Starbucks because they're moving so fast, right? Questions, thoughts, comments? Okay. All right, let's eliminate a business line. So what do you have that you're doing that maybe people are looking at and say, well, you know, this is low volume, low multiplier. It's the effort for creating revenue and the profit that goes with the revenue in this particular business line isn't balanced. It's not worth it. We have to do a lot of work for just a little money, like you said, Carrie. And then the people that are working on it, are they highly talented people that we can put elsewhere on a high volume, high multiplier work? And let them, is it work that they really want to do? And are there delivery issues? So is it that, you know, you just can't find the people? It's kind of common today. You can't find the people who are going to do that work, or, you know, people have left, or, you know, I don't want to work with a client in Alaska. I don't know. So there's delivery issues that go on. So more conversations around what's the utilization potential, what's your profit? So you're using all of these tools, all of the reports, all the financial tools to understand what's going on right here in that business line. How about an altered employee benefit? So I have a person that I know that has been paying 80% of the overall healthcare premium, and he was thinking about going to 100%. And we talked about, well, what's the change? It's an impact to the multiplier in professional services, because that's going to increase that indirect cost. And so what does it look like? What kind of impact do you have? Are you willing to eat it? Are you going to be able to raise your rates? What are you going to need to do? And then what's the cost per employee, and how does it fit with your vision? So there's a lot of conversation here, a lot of decisions that this is fit with the vision. For him, it fit with his vision. He's a chef. He's a private chef. and chefs don't have a lot of benefits. So he's one of the premier private chefs in Seattle, and he's offering this phenomenal benefit that no other chefing company does. So for him, it is huge because it talks about retention. He's already raised his rates to cover it. He's found a really good plan that's not horrendously expensive, which I find really interesting because it's all horrendously expensive, and it fits with his vision. I want this to be a place that chefs come to work, to bring their talent. And if you've never, ever, if you want to, you can go look out they publish food porn every day. It's down to earth cuisine, and look on LinkedIn. It's amazing. It's like, oh, can you make me lunch, please? So he's pretty funny. But that's the kind of thing you're looking at: multiplier, indirect costs, your cost per employee, and how does the decision fit with the vision?
Hey, Jess.
Yeah.
There's a question in the chat box, if it's a good time for it. Sarah's asking, how would you calculate the value of an employee whose function is overhead and not billable?
How do you calculate the value? Explain a little bit more about the value statement.
Sarah,
you can unmute if you want.
Sarah, can you unmute and clarify? She's saying the cost of employing that person. So salary, benefits, fringe, PTO, all that, workers' comp.
So let me take a look at the question again. The same way you would calculate the cost of any other employee. What do you pay them? What are the benefits that go with them? What are the taxes that go on them? And not bonus, but the one other one, I can't remember what it is right off the top of my head. And you calculate their cost just like any other employee. So however, their cost goes over an indirect because they're overhead. They're an accountant, they're marketing. They don't do any of the direct work. Now, the thing that I always try to do, this is a really interesting question, to justify the expense. Yeah, and that's the hard one and I'm guessing that you're probably looking at somebody and saying, we need to give somebody a raise. And everybody's saying, no, we don't need to give someone a raise. They're already a cost of doing business. So there's a couple ways that I look at this. My philosophy is that if you are transparent enough with how the financials work, people will understand what happens when you give someone a raise and what that means, even if they're overhead. And part of the reason that I became an operations management consultant working on the admin side is because so many times in my career, what I heard the administrative engine being talked about as was a necessary evil. And it's kind of like, no, these people are not evil. And when I go back to engineering, when I go back to my engineering school and talk to the engineers, and I know that we spend a lot of time making fun of the people in the business building. My response to them is, you need to go over there and you need to make friends with the accounting, the MIS, any other business function over there, because you're going to need them when you open your own firm, because you don't know squat about how to run a business. You know how to be an engineer or an architect or fill in the blank. And in the gross vernacular, what I tell people in specialized professional services is, don't do shit you're not any good at. Excuse my French. But a lot of people aren't good at this stuff. So they're looking at the admin side as a necessary evil. Going back to probably you're going to give somebody a raise. So if the text everything bill about. Yeah, and that, Sarah, that's really a good justification. That's the way to do it, is to say, look, this is all the time that I freed up. So if I freed up in all of these other times by taking this on, I freed up, let's say 10 hours a week. What's a blended rate on the people that I freed up? Let's say it's $100 an hour. It's $1,000 a week that you are putting over into billable work, right? You're giving them 10 hours and $100. And so $1,000 a week is $52,000 a year. Shouldn't I get 20% of that, 50% of that, as part of contributing my contribution to the company? That's how I would pose it. To say, I saved all these people all this time, And I got all this stuff done and I gave time back to billable. You know, I increased the utilization of billable personnel by what I did. And so that is a direct calculation to what you are now able to bill. And so, yeah, I should get a portion of it. I'd go straight. I mean, that would be me. I would go straight at it that way. And you gotta understand, I'm pretty direct and pretty forceful when I want to be. And I don't take a whole lot of crap from anybody. It's like, this is really stupid. It's the same thing. So it's what we call, there's a book out there called Value-Based Fees, which is a really interesting book. It's written by a guy named Alan Weiss. And he's also on YouTube. He's really funny. He's a little New York guy. He drives up in his videos in a red convertible with a white German Shepherd in the passenger seat. And he gets out and he starts to talk. And he's really funny. But one of the things he says, you know, as an operations person, if I come in and I save you $1 million a year over year for the next 5 years because of what I do today, that's $5 million. You should pay me 20% of that. Pretty easy to do the math, right? I'm gonna save you this. Now, I don't have any control if you screw it up, but I set it up so you can do that. So, you know, Sarah, great question. And yes, you should try and calculate what it is that you've enabled in the billable side and say, I think I deserve part of that. I did this for you. So I made it better. Buying another business or merging, you know, there's organic growth, which is just growing, you know, add people, add projects, do that. Some of the other ways is acquire and merge. And so one of the things to look at is what's the market potential? If I'm 40 people and I'm looking at merging with another firm that's my competition, that's 80 people, there's 120 of us, and my competition that I'm merging with is national. So we get to do a whole bunch more interesting projects. We get to do them in different places. We can take on the best that their culture has to offer. They are probably a little bit more sophisticated than we are in processes and systems and tools. What's the growth rate we can get out of that? I'm going to skip cultural blend for a minute. Complementary, do we have a complementary service or product, or are we, since we're competitors and doing the same things, can we do it better as a larger group? And how do we do that? Do we create debt by getting a loan? Do we arrange something that's a profit sharing that pays off? How do we do that? So that's all, you're going to want to look at that and financially model it. So people look at the cultural blend piece is less financial than thinking about, but it has a financial component. Looking at the culture of a company that you might merge with or acquire is really, really important, because if you get cultures that go like this, that's a whole lot of productivity right there, because you're trying to figure out how to get everybody together. You want a culture that does more this than this. And I'm witnessing this in a person I know. He's looking at merging with a competitor, 40 people and 80 people. And the one reason he's so excited about it is their cultures are very much the same. So he's anticipating that there's going to be more meshing than there is running into each other. So but that is a lot of people say, oh, well, I'm not going to worry about culture. It's like, well, you better, because your utilization and productivity are going to go to crap if you're not careful. Questions or thoughts there? I see some smiles. Have you been through a merger? All right, so last one, open a branch office. Now this is a really interesting, I was running through this and I said, people don't open branch offices like they used to anymore. So it's really interesting, because I put in a return on investment timeline. Kind of like, I don't know that people are opening branch offices by leasing anything. I think they just go into the city and find a couple people and set them up to work from home. So there is a cost, perhaps, of equipping someone in, you're opening an office in Denver. You're going to expand to Denver because you've had lots and lots of projects there. And hey, you ran into an architect one night when you were, or someone when you were having dinner, and they said, oh yeah, I'm a freelancer, but I'm looking to affiliate with a company. And you go, great, I've got a person there. We can start doing this. What's the cost to open the office if you're going to lease it? What's the cost to send equipment to someone? How are you going to staff it? And what's the market potential that you've had? So have you been struggling to get things done in Denver? Well, there's a ripe, it's ripe with work. So I have another person I know, an architecture firm that is looking at Austin, but they're so busy in their other offices, they can't get into Austin. It's kind of like, lots of work in Texas. If you want to work in Texas, they all need architects. Not that you're all architects. So any questions or thoughts about that? Is it starting to show, where these tools all start to come into play and how you have conversations from the financial information and make decisions on what you're doing with the business? All right. I'm going to leave you with one other thing. So this is the one that's going to make you look really smart if you haven't already done this. You want to spend some money, okay? You want to buy it, but your boss or CEO says, nope, don't do it. Can't do it. Not going to do it. All right. Do you know what your revenue to spend ratio is? Your financial person will be just in awe of you if you can figure this out. So how much revenue does a company need to bring in to give you $1 to spend? Okay. So here's the calculation. And this is a true story because this was my IT manager. And I said, I need a budget from you. And she said, okay, I need $300,000. And I went, oh, great. You know how we're going to get it? She said, no. Well, let me explain it to you. All right. The company's profit margin is 15%. So for every $1,000 in revenue the company brings in, the company keeps $150. Okay. To do what they want with. And they've got to cover bonuses and a lot of other things that goes with it. So if you want to have $300,000 to spend, that means the company needs to bring in $2 million in revenue to spend $300,000 on that budget. Now it's not all at once, right? But at the time, it was $250,000 per employee per year. That was 8 people working specifically for her to have $300,000 to spend on IT. And when she finally grasped this, because she was pretty smart, her eyes got really big and she said, oh, I can probably cut that in half. I'm like, great. We can defer some of that to another year. I don't need all of that. It's like, great. And she took different approaches on things that she did in IT, which were really great. And there's new processes. She looked at licensing different, the cash flow. So with the licenses, all the licenses we had for AutoCAD and for what became Office 365, Exchange and all that, she said, oh, if I do this and tinker with this a little bit, we don't spend as much on licensing because we pay it by quarter instead of by year. And Microsoft likes it when they get their money early. So, just like everybody else. So revenue to spend ratio. If you know what your profit margin is, and you know how much money you want to spend, you know how much revenue that's going to take. And so that's something handy to have. Say, well, it's only this much in revenue to get the money to do that. So, but that is one of the things that your owners, founders, and CEOs are thinking about is, okay, where is it going to come from? And will I have it? Can I maintain my profit margin? So I have this pool of money to be able to spend on investing in the company, which is the IT budget, or investing in the people, bonuses, raises, all those kinds of things. Any questions on that? It's a pretty handy little dude to have. Okay. Well, so
Perfect
key
timing.
takeaways. Pardon?
It's a perfect time. We're at the 10-minute mark. Good job.
Hey, 3 keys here. Cash is critical. All businesses do the same 4 things. And business decisions rely on all of the information that comes from all of those crazy, boring financial reports and ideas in some form or fashion. So, thank you. There it is. Hopefully that was helpful. If you have any questions, if you have any questions or want to talk to me later, here's my contact information. You'll have this, but are there any questions now? Pieces of discussion?
Yeah, you killed it. Yes. Is there any comments? Anybody look at things differently? It's just the takeaways that you are going to go back to your firm leader with?
Go get them, Sarah.
I had just a quick question. Aside from the asset turnover, is there another good KPI that would be helpful for people that are just starting to take a look at those kinds of calculations?
Sure. It depends. Actually, I have a whole KPI deck about all the different KPIs that you can put together, and I'll send it to Brittany. Depends on where you sit. I mean, it truly does. The administrative side's a little harder because because it's not as clear cut. And, on the revenue side, it's kind of like, oh, this many employees been doing this, right? So it's more for me, more saying, okay, let's put out a budget. And there are some firms that don't like the budget. There was a firm I worked with that's like, I don't do budgets. What are you
It's
talking about?
wild.
Yeah. How do you live? Well, the answer was you don't. A budget, this is my budget for this. Where am I against these items in it? So that's more of a spend as opposed to an in. It's more of an out. Am I spending more? Why am I spending more? If I have a $5,000 budget for the year, that's I can't do that math. Sorry. If I have $600 a month, something like that. Anyway, am I spending $600 a month? If I spend more, am I going to spend less the next month or several months from now? And recognizing that spend kind of does this.
Mm-hmm.
It's not a straight line, but you can average it over, you can peanut butter it over the year.
Mm-hmm.
So it's really more of an outgo. And so it's really what's important. You think about it from the context of what's important to tell people how well or how well I'm doing or what challenges I have.
Okay. We're smaller and I track all kinds of things. I track our overhead rate, I track our utilization rate, I look at, our net profits and all that stuff, but I haven't done like true KPI kind of calculations.
Okay.
So it's like I have all these bits and pieces, but to try to kind of connect some of those dots, it's like, I don't know where to focus.
In that, so my recommendation is that the top 3 KPIs are net profit.
Yeah.
You have sub-consultants, right?
Yeah.
Gross profit and net profit.
Yep.
So net profit, you want to watch SG&A. I don't know if you call it SG&A. Not everybody does.
Selling, general and admin.
Sales, general and administration. So that's a line item you want to watch. And then utilization, absolutely knowing what your break even is versus your average. Those are really the top 3.
Sarah Davies asks, what is a profit margin?
Very
new.
A profit margin also, thanks for asking. So the profit margin is also known as EBIT. A lot of people will call it EBIT or EBITDA. EBIT is expenses before depreciation, interest, and expenses before interest and taxes. So, and then DA is DA, depreciation and amortization. Not everybody takes the DA. So it's what's left over after you've pulled all your, you've gotten all your revenue in, you've paid your sub-consultants, you've paid your rent, your utilities, your salaries, all those expenses, and then any interest that you pay on the loan and any taxes that the company pays, that's what's left. So the 15% profit margin we're talking about is net. So it's net of all operating expenses. Does that make sense? Any other clarification you need, Sarah Davies?
She said, awesome, thanks.
You're welcome.
Yeah, Jess said that's awesome. If you want to share, I have a KPI library too that I'll send, but Deltec and AIA put out some awesome annual reports. So if you're in the architect field, I always grab from there, and they've got monetary and non-monetary ones that are just phenomenal. And Jess, I wanted to ask you, because I've got a cool new program for anybody who uses QuickBooks Online. It's not so new, but I've started using it about a year ago, called Fathom. And so I just was curious, Jess, on what your process is for KPIs and calculated. Do you use a program? Are you using Excel? Like, could you kind of walk through what's
available?
I haven't
calculated a KPI for a long, long time.
Would
Because I'm just me.
Yeah. No, for sure.
So what I did to start off simple, I'd like to keep things really, really simple. And, software can get complicated. In working with my client that said, I don't know the difference between KPIs and goals. I was working with her VP of sales, and I just did a simple spreadsheet because they are a direct to import company. They also do other OEM, which is furniture. They do furniture manufacture, home goods, China. They do plates, dinner plates. And they sell in 3 different areas, and they each have a commitment of a certain amount, and then it's split up in 3. And they have an e-commerce piece, which is really crazy. And so we just did it. We said, okay, VP of sales, if your overall commitment is 12 million, you got to run $3 million, or I'm sorry, $1 million a month. And how does it split up underneath it? And it was really simple to see and simple to explain and simple to track. It also shows how you get there. And a lot of times the thing about the software is it goes in a black box and comes out and you have no idea what the black box did.
Yeah, totally.
Yeah.
I love that.
I will also send I just went through a really interesting exercise by a guy named Daryl Mullis, and he is with MetaMark Learning.
Mhm.
And I will send that information. You can take a look at his website. He does a really great course on
Ooh.
all the financial stuff. And he actually, when he does it online or when he presents in person, he has this giant rug that's hanging on a frame, and he has these little things that stick that are dollars for, cash and accounts receivable and assets, fixed assets and prepaid expenses. He's really funny. He's so droll, really good.
Oh, yeah,
Really
please do.
good. So I'll get you his information too. Yeah.
Yeah, and for anybody, in the finance or bookkeeping arena, SCORE puts on some amazing financial workshops, like beginners, QuickBooks, so I'll send some references too, but yeah, they just have some great presenters on these topics beyond Jess. And please use Jess as a resource too with her contact information. She's always willing to help and donate some of her time, and you
Sure.
go.
Yeah, and I mean, I've just so you know, I am a licensed engineer.
Yeah.
I've worked in construction. I've worked for an architecture firm. I've worked for an engineering firm. I've worked for a corporate real estate department. So, I've worked with CFOs and controllers. And so there's not a piece of the business that I probably haven't seen or can figure out. So.
Exactly.
Yeah.
Well,
and Sarah, if you want a little coaching on having that conversation, happy to talk with you.
Definitely.
Yeah.
So unless anybody else has any further questions, we'll do a quick closing and take it from there. Got Sarah in the chat box says great presentation.
Thank you.
So this is 1 of 4 and hopefully many, many more in the coming years. I'm going to try to steal Jess as much as she'll allow me. So you definitely knocked everybody's socks off. I'm definitely. So we'll have the recording out in a day or 2, along with the PDFs from Jess and some references and all the other good nuggets she was graciously willing to offer, as well as a feedback form. Jess's email will be in that as well, or you can get a snip of this and I'll put it in the chat box as well. Beyond that, we have another one coming up in April. So this wasn't a legal one, contracts, electronic signatures, just project management, risk management. So registration will be open for that soon. Beyond that, everyone have a good day. Happy St. Patty's Day. And Jess, thank you. Amazing job.
Good work. Thank you.
Good to meet you.
Great. All right. Bye, guys.